Welcome to the Deep Dive, where we unpack the numbers and the narratives behind the market's biggest moves. Today, we're digging into Brown-Forman, ticker BF.B. Their latest earnings call for Q2 fiscal 26 was, it was a real nail-biter.
Oh, it was critical. I mean, you have to remember the backstory here. The company had already slashed its guidance for the year pretty dramatically.
Yeah.
So this call wasn't about growth, it was about stability. Could they even hit that much lower bar?
And the market reaction just told the whole story, didn't it? This volatility was just incredible. We saw shares pop right at the open, which felt like relief. But then it just fizzled out.
It did. The stock swung from a low of about $28.80 to an intraday high of almost $32. That's a huge range. And the trading volume was more than triple the average. You could practically feel investors fighting over the story.
Is the company stabilizing, or are the headwinds just too strong?
Exactly. And by the end of the day, skepticism won out. The stock closed down about 1.3%.
So our mission today is to figure out why. We're going to unpack all that tension for you. We'll look at everything from geopolitics to product innovation to see what's really driving this very deliberate reset year for Brown-Forman.
Let's do it.
Okay, so let's start with the headline numbers. The results for Q2 fiscal 26, which came out on December 4th. At a glance, it looked like a classic mixed bag.
It was a very mixed bag. On the top line, they just squeaked by with a beat. Net sales came in at $1.036 billion. That was, maybe 9 to 16 million ahead of estimates, a tiny margin.
So a beat is a beat, but it's not exactly a blowout.
Not at all. And reported net sales were still down 5% from last year. Organically, which strips out some of the noise, it was a little better, down just 2%.
Right.
But still down.
Right. And then you have the earnings per share, the EPS, which is a different story.
Yeah, that's where they stumbled a bit. JAP diluted EPS was 47 cents.
Mm-hmm.
The consensus was looking for about 38 cents, so slight miss there.
And that miss translated to a pretty steep drop year over year, right?
A very steep drop, down 14%. So, that's a significant profit decline.
So what's the big takeaway from those numbers? Management seemed to be trying to calm everyone down.
They were. They basically said, look, this is a continuation of Q1. It's pretty much what we expected. And the most important thing they said, really, was that they reaffirmed their full-year guidance.
And that guidance is for a low single-digit decline. It feels weird to get excited about reaffirming a decline.
It does. But that's the environment we're in. The bar was just so low after the big guidance cut in June. So the market's initial reaction, that pop, was just relief that things weren't even worse.
But the skepticism crept back in.
Because at the end of the day, they're still contracting. The sales beat was razor thin, and the fundamental problems haven't disappeared.
Okay, so let's get into those fundamentals. The operational details really show this massive split in their global performance.
It's a tale of two markets, really. All the strength came from outside their traditional developed world. Emerging international markets were up a really strong 12% organically, and global travel retail was up 6%. As people get back on planes.
And drilling down into those emerging markets, Mexico seems to tell a really interesting story about what consumers are doing right now.
It really does. Mexico was a powerhouse, and it was all driven by their ready-to-drink portfolio, their RTDs, specifically New Mix RTD, which is a local tequila drink. It surged almost 30% organically.
30%? That's incredible.
It is. And management was very clear why. The economy in Mexico is a little subdued. So consumers are trading down. They're looking for value, for convenience, and that's exactly what New Mix offers. Brown-Forman is just perfectly positioned for that behavior.
A great example of being nimble. But that strength in Mexico was unfortunately wiped out by weakness elsewhere.
Completely.
Yeah.
Developed International was down 6% organically. We saw softness in the UK and Germany, and then there's the whole situation in Canada. Meanwhile, the US market, their biggest by far, was just flat.
Flat. So stagnation at home.
Pretty much. Now, some of that flatness is because they're not carrying the Korbel and Sonoma Cutter brands anymore, which helps the comparison a bit. But still, you want to see growth in your home market.
And what about the big, iconic brands? How did Jack Daniel's and Herradura do?
They struggled. There was pressure on core Jack Daniel's Tennessee whiskey for sure. And the tequila portfolio was a real headwind. Herradura was down 11% organically. That pulled the whole tequila category down 3%. When your big guns aren't firing, it's tough.
Okay, now we have to talk about the two elephants in the room. These two massive external drags that management kept highlighting. They said together, these took more than 2 percentage points off their first half revenue growth. Let's start with used barrel sales.
Right, this sounds kind of obscure, but it's a big deal for them. Used barrel sales were down over 60%.
60%, why?
So because Brown-Forman is a huge bourbon producer,
Yeah?
and by law, bourbon has to be aged in new oak barrels.
They have a ton of used ones left over.
Exactly. Thousands of them every year. And they sell them usually to Scotch and Irish whiskey makers who use them for aging their own spirits. It's a really nice, high-margin business.
But that business has fallen off a cliff.
It has. Not because of anything Brown-Forman did, but because those international whiskey producers, the Scotch and Irish guys, have slowed down their own expansion plans. They're just not buying as many barrels right now. So it's an immediate hit to the bottom line that has nothing to do with consumer demand for Jack Daniels.
And the second factor is much more political. The Canadian boycott. This is the source of that catastrophic 60% decline in Canada.
Yeah, it is. It's a major trade dispute between the U.S. and Canada. And the result is that U.S.-made spirits have been pulled from the shelves in most Canadian provinces.
So this isn't consumers choosing something else. The product just isn't there to buy.
Precisely. It's a government action. The provincial liquor boards control everything, and they've delisted the products. It's an almost total shutdown of a major developed market due to politics.
Wow. And management said their entire forecast for the year assumes that situation continues.
Yes, they're assuming that 60% drop in Canada persists for the full fiscal year. And when you're dealing with an external shock that big, it forces you to get really, really aggressive with the things you actually can't control.
Which brings us to their strategic reset. They're performing some pretty significant surgery on the business.
They are. They're deep into a major restructuring. This includes about a 12% workforce reduction. They're also closing their own cooperage, where they make barrels.
So they're getting leaner.
Much leaner. They've already booked $16 million in charges for this stuff. And it helped drive their organic SG&A costs down 4%. This is all about setting themselves up with a lower cost base for when growth does eventually come back.
And what about the big distribution overhaul in the U.S.? That's been a source of anxiety for a while.
That's done. And that is a huge relief for investors. 13 markets switched distributors on August 1st, and management said it all went smoothly. They hit their goals, they got more investment from their new distributors, and crucially, they improved their own margin structure on U.S. sales. So now the focus shifts from managing the change to actually executing with the new partners.
So while they're cutting costs in one area, they're still pushing forward on innovation. And that seems to be where the real bright spot is, specifically with Jack Daniel's Tennessee Blackberry.
Yeah, this is the really compelling part of the story. The launch of Tennessee Blackberry is just blowing past all their expectations, not just in the U.S., but in the U.K., Germany, France. In the U.K., at Tesco, it was the single best new product launch in the entire spirits category.
And what's so fascinating is who's buying it. It's not just the usual Jack Daniel's crowd.
That's the key. Management said over half of the people buying Tennessee Blackberry are totally new to spirits. This isn't just stealing sales from another Jack Daniel's flavor. This is growing the whole category. It's bringing new, maybe younger drinkers in. That is how you future-proof an iconic brand.
And all this discipline, both on costs and innovation, it's showing up in the margins, which is pretty impressive given the sales decline.
It is. Gross margin actually went up 30 basis points in the first half to 59.5%. Part of that, to be fair, was the absence of those transition service agreements for the Korbel brands. Now that those are gone, the drag is gone, and the core business looks more profitable.
And stronger margins mean stronger cash flow.
Absolutely. Free cash flow jumped up to $236 million in the first half. That strength gave the board the confidence to authorize a new $400 million share buyback. And maybe most importantly for their long-term investors, they raised the dividend again by 2%. That makes it 32 straight years of dividend increases.
42 years, a true dividend aristocrat.
No question.
Okay, let's pull all this together and think about the big picture for you, the investor. The stock was already down about 20% on the year coming into this. The market was braced for bad news.
It was. And this brings us back to that huge debate. Is the consumer slowdown cyclical or is it structural? Management is seeing clear trade-down behavior. The really expensive stuff, those $100-plus bottles, are down 18% in value. That's a huge drop.
And their argument is that this is cyclical, right? It's just the economy, and people will come back to premium spirits when they feel more confident.
That's their primary take. They see pricing in the industry as rational, no crazy price wars, which supports that view. They believe that once the macro pressure eases up, those drinkers will return.
But the big fear for investors is, what if it's not? What if this is a permanent shift? You hear so much about wellness trends, health, GLP-1 drugs, maybe reducing alcohol consumption.
And that is the central tension that's causing all this stock volatility. Management acknowledges those structural shifts, but their focus right now is on controlling what they can control, the restructuring, the U.S. distribution. Their view is that the political and macro headwinds are the main story today.
What about advertising? You'd think if sales are slow, you'd spend more to gin up demand.
Their philosophy is a little different. They tie ad spend to depletion-based sales, so what's actually selling through to consumers. They said very clearly that you can't just advertise your way out of a category-wide slowdown, so they're being efficient, backing their big global campaigns, and really focusing investment on proven winners, like the Blackberry launch.
The message is cautiously constructive then. A tough year, but we're laying the groundwork.
That's it, exactly. FY26 is the reset. They're focused on what comes after.
Okay, before our final thoughts, it's time for our favorite segment. This is not financial advice. This is purely for entertainment, a high-risk, high-reward trade idea based only on what we heard on the call. What have you got for us?
Well, the setup is based entirely on those two huge external weights we've been talking about. All the consensus forecasts for Brown-Forman assume that the 60% plus decline in Canada and the drop in used barrel sales just continue all year. They're baked into the price.
So the trade is a bet against that political risk. How would you structure it?
It's a paired trade to try and isolate the specific opportunity here. You go long BF.B, the Class B shares, and you fund it by selling short a broad, slower growth consumer staples ETF, something like XLP. This hedges out some of the general market risk and focuses the bet on Brown-Forman itself.
Okay. And what is the outrageous but plausible catalyst that makes this trade work?
A sudden, unexpected diplomatic breakthrough. Imagine you wake up one morning and the news is that the U.S. and Canada have resolved their trade dispute, and the boycott on American spirits is lifted, effective immediately.
That would be a huge surprise, and the impact would be
Instantaneous. You would immediately remove a multi-point revenue headwind. You're talking about a 60% hole in a major market just vanishing overnight. And given how high short interest is on this stock and how poorly it's performed, taking that massive political risk off the table would, I think, trigger a very rapid re-rating of the stock back toward its historical premium. It's a geopolitical gamble on a resolution that nobody sees coming.
a very interesting one. All right, let's wrap this up with the final takeaways for you, our listener. The story of Brown-Forman's Q2 is really one of flawless execution of a defensive game plan. They hit the low sales bar they set for themselves, they took an axe to their cost structure, and they fixed their U.S. distribution.
But those external headwinds are real, and they're not going away quickly. Canada, the used barrel market, and just general softness in developed markets, these things will define fiscal 26 as a tough reset year. Still, despite all the noise, they bought back stock and they raised their dividend for the 42nd consecutive year. That tells you a lot about the underlying financial strength. So the big question for you is this. Is this stock now priced like an ex-growth bond, just a slow and steady dividend payer? Or is all this restructuring, plus the innovation we're seeing with things like Tennessee Blackberry, enough to power a real return to its premium compounder status once we get past this very difficult year?
A great question to end on. Thank you for joining us for this deep dive.